This conference will now be recorded.
All right, it's all yours, Lonnie.
Thank you. Thank you. Good afternoon, everybody. I'm just going to cut to the chase and call this meeting, the September 23rd, 2020 meeting of the Connecticut Green Bank Board of Directors to order. Do we have any public comments? No. Okay. So moving on to the consent agenda, the first item, the meeting minutes for July 24th, 2020. Does anybody have any questions or changes? Okay, hearing none. I think I'm just going to keep product from piling up. So do I hear a motion to approve the meeting minutes for July 24th, 2020?
Motion to approve. This is
John
Brenda.
Hardy.
And I'll second. This is Brenda.
Okay, great. Thank you. All in favor?
Aye.
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 Opposed? Anybody abstaining? Okay, meeting minutes are approved. The second, and I should say also, the things that we've all been dealing with, dealing with really responding to the roller coaster ride we're all on with COVID and the up and down economy. And so we're going to be talking today about revisiting, restructuring, responding to being able to stabilize programs and our contractual obligations and relationships and the companies that we're in business with. And so I'm just saying that just because this meeting might go a little bit longer than originally anticipated, might be 10 or 15 minutes, because there's a lot of structural stuff that many of us might have questions on. So the first item is really, and I think Bert's going to talk to us about,
Sorry, forgive me.
Madam Chair, I think we're going to go to the consent agenda first.
Okay, well, that's what we were on.
Yeah, we have the second item left, Chair Reed, on the USDA loan application. And
Right.
let me give a brief overview of that so the board can get some background. You might recall back in July, at the July board meeting, you approved of the staff submitting a loan into the Rural Energy Savings Program of the USDA. The team led by Bert Hunter and Matt Masunis did an excellent job pulling that application together. We submitted that in early September. The board had approved of us submitting it, but there are a couple of items in there that we just wanted your approval on that dealt with financial forecasts and the implementation plans. So this is really just the dotting the I's, crossing the T's in the event that the RESP team comes back to us requesting the board approval of that part of the loan application. So that's what the second resolution there is for those of you who took a look at that application.
Do we have any questions? Okay, and as I understand it, that application is in now. You got it in early.
Yep, it's in.
Good. And that's a $10 million application.
Perfect. $10 million, that's correct. 0% interest paid back over 20 years.
Excellent. So why don't we move this one too, right?
That's right.
Yeah, good. So do I hear a motion to approve the USDA loan application for the financial forecast and the implementation plans? Do I hear a motion?
So moved.
A second?
Second, John Hardy.
Discussion?
Second,
Okay.
John Hardy.
Okay, great, thanks. All in favor?
Aye.
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 Opposed? Any abstentions? Okay,
All
good.
Excellent, excellent, excellent. And just a couple quick notes. So we did leave with the board in your packet the Q4 report from Inclusive Prosperity Capital so that you can see the progress to targets through June of this year. We try to provide those quarterly memos. We submit ours as well, but just wanted to give you all that. Wanted to talk briefly about some announcements. In June, when we went through the the fiscal year 2021 budget, we had proposed two positions that we talked about. One was a director of incentive programs, which at the time we had Celia Price, and then we had another position in that budget, which was a senior advisor to the president and CEO. So we have some leadership changes on the incentive programs. Sergio Carrillo is the new director of incentive programs for the Green Bank. He went through an extensive search process over the summer. At some future point, he can give you a sense of that process. We're excited that he's joining us. He comes to us from the Chesapeake Utilities in Delaware. And is going to be a great addition and a leadership addition to the team. Celia Price, as we talked a little bit about, is in transition. She's in the process of relocating to Michigan. So we are so fortunate to have her to be able to continue to help us transition the leadership role and serve to support Sergio as he comes on board. So those are a few of the leadership changes within the organization. And Celia, for the time being, will be the senior advisor to me, which really just means that she's going to help support the transition of Sergio. So wanted to make those announcements.
I think the board, we really want to thank Celia. I mean, talk about a 24/7 job. And for your dedication to the Green Bank and to the people of Connecticut. And we just wish you happiness and success in your next chapter. And
Thank you
welcome,
so much.
Sergio.
Celia has been amazing through a couple of transitions and incentive programs. So thank you. And also, Brian, could somebody, unless I missed it, circulate Sergio's CV just so we have more, background?
Will do, definitely.
I see that Sergio was Director of Corporate Development and for Chesapeake Utilities and also led their renewable sustainability strategy. So that's perfect. Welcome, Sergio.
Thank you. Appreciate it.
Excellent. Okay, we're ready to move to the agenda item 4. Sure.
Okay, let's move on and get ready, Bert. So we're going to we're going to talk about investment updates and recommendations, and one of them is going to involve a return to the senior loan position for CPACE projects, and so eager to hear from you, Bert.
Sure. And I'm going to pass this over to Mike Yu in a moment. This is something that Mike, myself, and Mackie Dykes have been working on for several weeks now, as well as other members of the financing programs team. So the issue has been that with the passing of, or not passing, really the enactment of Executive Order 7S, which I'm sorry, I'm getting some feedback. If you're not speaking, if you could go on mute, please. Thank you. The Executive Order 7S by Governor Lamont mandated that each town allow for deferral of payments or a low interest payment plan for property taxes that were due in July. And that executive order applied as well to benefit assessment liens, meaning commercial PACE assessments. We were trying to determine how this was going to affect not only our portfolio, but more generally, but more specifically, the portfolio that is part of a private securitization with Clean Fund that was done with Clean Fund back in 2014 and 2015. So when we reached out to a number of property owners, it turned out that 7 of 9 property owners had already elected for the deferred payment strategy, which means that they could defer payment until October 1. Was not clear whether they expected to pay on October 1st or would have additional issues with payment. This was going to cause a very complex series of events between us and Clean Fund and their securitization in terms of payments that are due ultimately under their securitization, which we did not feel comfortable stepping in the middle of because we have a subordinated lien position in that transaction. So in order to, so in other words, if we worked out with the customers that we would provide some COVID relief to them to assist them with their overall payments, those strategies would not be able to be rolled over to Clean Fund in a neat way because it's in a securitization and it made clear that they weren't going to be able to extend any maturities of the bonds. So we got into a situation where we talked internally and we determined that it would be much cleaner to handle these proposed restructurings by the Green Bank taking back by way of a restructuring with the customers the benefit assessment liens. And because of the way the indenture is structured within the Clean Fund securitization that we have for our benefit assessment liens, which resulted in bonds issued to Clean Fund, which Clean Fund then put into a follow-on securitization, which causes the lack of flexibility. It's necessary that the transactions be restructured with a new financing agreement in order to put the revised payment schedule in place and to retire the Series A bonds that Clean Fund has in the tranches, particularly Tranche 1 at this time, where we reached out to customers and determined that that was in order since, as I mentioned, 7 of 9 had already elected for a deferred payment strategy under Executive Order 7S. So that's the high level here, and the permission that is required, because it's going to be an additional $8.6 million of Green Bank capital, about $4 million for Tranche 1, and another 4.5 to 4.7, depending upon accrued interest, et cetera, for Tranche 2. We necessarily need to get board approval in order to bring those transactions home. So I'd like to pass this over to a description of what's going on more specifically over to Mike Yu, who's on the line, and he can walk us through it, and then we can circle back and have a discussion about what's being requested here. Is that okay, Chairman Reed?
Absolutely.
Okay, thank you. Mike, are you there?
I am.
Mike,
thanks, Bert.
Okay, great.
Afternoon, everyone. Following up on Bert's initial comments, I'll just give some more details into the structure and the transaction. So when we did the deal 6 years ago, the facility was sized to accommodate $30 million of CPAY sell down to Clean Fund. Ultimately, we ended up selling about $17 million. If you go on the next slide, you'll see those the 17 million split between 2 tranches. And this was sold through a bond structure. So there was a newly created entity, the Public Finance Authority, who issued bonds against these portfolios and their expected revenue, a series of 3 bonds, A, B, and C. And the Series A bonds were sized to about 80% of the net present value of these revenues, with some discounting in there and some negotiated rates. And Clean Fund then purchased those bonds, and those proceeds came to the Green Bank, and that allowed us to refresh our warehouse capacity. The Green Bank then took those B and C bonds and held them on our books, and we continue to get interest income from those. Importantly, though, I would note that those B and C bonds are subordinate, and so they are the first loss position in this structure. And so it was a structure where Green Bank added credit enhancements to private capital and was able to refresh our capacity. And it was a landmark deal at the time. It was the first securitization of C-PACE deals, and there have been many since then, but this was the first, and it was quite important for the industry. But as Bert and Chairperson Reed have mentioned, a lot of these borrowers are caught between COVID and our structure at this point. There's a lot of economic uncertainty, and per the governor's executive orders, many borrowers are deferring their payments. And we expect potentially more borrowers to request restructuring down the pike as the economic uncertainty continues to roil through Connecticut and the country. If Green Bank owned all these, we'd be able to accommodate them per previous board approvals. But as Bert mentioned, Clean Fund has securitized their own bonds as collateral for another securitization, and so they're ultimately not in control of the bonds anymore. That's their investors, some of these large pension funds, and made it clear that they're not going to accommodate any extensions in maturity, which is what these borrowers need, right? They need more time because they need to defer some payments. And so that's why we want to try to, through multiple sessions of brainstorming with Clean Fund, we haven't been able to find a path forward within the existing structure, which is why we need to restructure the benefit assessment liens to provide that flexibility to the borrowers. And so that's what we want to do on the next slide. Is we want to start with tranche 1. It's a little smaller. There's more concentration of borrowers, and so it's easier to get a sense of how everyone's reacting to the proposal there. And through our outreach, we've found that out of all those 9 deals, every single borrower is willing to work with us in the restructuring in order for us to get the liens back on our books. There's about 5.6 million of outstanding benefit assessment lien currently throughout those 9 deals. Two of them have paid off out of the original 11, and it's the restructuring is pretty simple at the heart of it. It's allowing them to defer one payment if it's a semi-annual payment, or 2 if it's quarterly. And we're going to keep the value of the payments the same, and then tack on a payment at the end to cover the deferred one. So there's an example in the memo write-up that you can look through, but it's basically moving a payment from now until the very end. This reduces the effective interest rate a minimal amount, but I think we're happy to accept that given sort of the benefits we gain from doing this. In some cases where borrowers don't want to do it, don't want to go through the hassle, we may need to sweeten the deal a little bit to offer incentives in some of their payment term accommodations. On the next slide, I've put up a sort of an illustrative refinancing here. It's a $500,000 assessment. So here, if the math works perfectly, you'd have 400,000 of A bonds that were issued against this assessment, and the B's and C's would be 50,000 each. And once the A bond would be paid off, and in the process, we'd incur a $12,000 prepayment fee. So the Series A bonds have 3% prepayment premiums associated with them. So that's a cost that we would have to absorb on our end. But that loss, we think, is more than offset through the interest income earned over the remaining term. So here in this case, at the bottom there, you'll see the restructured BAL row. That would be projected to earn about $237,000 of interest income over the remaining term. And so, you sort of subtract out the prepayment fee and what we give up on the benefits, the Bs and C bonds, and you still come out ahead, both nominally and on a net present value calculation. So this $500,000 restructuring would help us bring back $400,000 net of secured C-based assets onto our books and generate, somewhere between $109,000 and $135,000 of interest income over the remaining life. Not modeled here, importantly, is that we would save a lot on legal and trustee costs. So if we were able to, once we get all the borrowers to do this, it would result in the dissolution of tranche 1, as all the series would be paid off, and we could collapse the structure, and we could not have to work with other legal counsel and trustees. And there's quite a large human cost component as well between us and Clean Fund and the trustees. So there would be some savings there that aren't factored into this model. On the next slide, we've sort of structured out how a diagram about how the restructuring would work, where the Green Bank would provide funds in the amounts of the outstanding benefit assessment liens plus any accrued interest, and that would pay off the Series A as well as the Bs and Cs, which are owned by the Green Bank. And then the Public Finance Authority would repay the Clean Fund loan, and the assessment liens would then come back to the Green Bank, which is what we want. And so with all that said, happy to take questions, but we would recommend and request the board's approval to proceed with these restructurings. First, targeting tranche 1 to close it down as quickly as possible, and then move on to tranche 2. We believe that this will enhance the Green Bank's income earning assets at pretty limited incremental credit risk, given that, remember, we already are the first 20% of subordinate of loss in this structure as the subordinate bonds. And so we're really just talking about bringing back the more secure 80% that's owned by Clean Fund. So it will have a big boost to our balance sheet. We'll be given, more importantly, I think, small businesses in Connecticut the breathing room that they need to get through this unique situation. So we want to work with tranche 1 first, and then focus on tranche 2 after we get through tranche 1. And given the number of borrowers that we have in tranche 2, we would request from the board that the resolutions be effective for 180 days after this meeting, as opposed to the standard 120 days, just because we do think we'll need that excess time to work with all the borrowers, do negotiations, and then actually execute on the restructurings. But with that, happy to take questions.
This is Lonnie. I know I had a little conversation, I think, with Brian and Bert about this. Is the Clean Fund, where are they in this process? Because I know you want to buy back the tranches, but you're prepared to go one by one if you have to, if you can't negotiate, their enthusiasm for this. Do you have any sort of sense where that is now?
Yeah. So for tranche 1, because it's in a onward securitization, as was in the diagram that Mike was speaking to. So we've got an additional layer to go through. They relayed to us this week that they would not be able to do an accelerated transaction with us just repurchasing the benefit assessment liens, or actually repurchasing their bonds in total. So they said that unfortunately they'd have to go transaction by transaction, which just means that we'd have to close this during the month of October on a deal by deal basis.
Does anybody, any other board members have questions?
I have, I think, two. One is, thank you guys for the presentation and finding a solution here. It says in the memo, nearly all the borrowers are amenable to refinancing. And so do we have a sense what, like, if we encounter a borrower who's not amenable or gets the sense they can hold us up because they know we need to do this, what do you have any parameters on the type of premium that we might have to pay?
Well, actually, since the writing of that memo, all of the property owners have agreed to a restructuring.
Oh, that's great. And then two, have we talked to? I mean, I know we're saving ourselves, we're on the hook for whatever 20%, so 3% premium is better. But have we explored what? And I think that on tranche one, that comes out to what, about $170,000 based on the remaining balance. Have we just kind of with legal counsel if there are anything we can do within the bond agreement that would allow us to ask Clean Fund to split that, or are we just on the hook for it?
No, thanks, Matt. First of all, as to the first question, I want to make clear that related to tranche, that response was for tranche one only. We have not, as Mike mentioned, we haven't done anything with tranche two yet in terms of discussing anything with property owners. So that response was for tranche one only. As far as the prepayment premium itself, that there's nothing. We looked exhaustively through the indenture as a team, and our in-house legal staff, and we concluded that there's no way around that fee.
Yeah.
And they were not amenable to anything less than what they're fully entitled to under the indenture.
Okay, thanks.
Any additional questions or comments? Okay. Do I hear a motion to move this resolution for restructuring?
So moved.
A second?
Second.
Discussion? All in favor?
Aye.
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 Opposed? Any abstentions? Okay, it's approved.
Okay, thank you.
Thank
you, Mike.
Thank you. I know everybody has worked so hard on this, and it's, these are unprecedented and unpredictable times.
Sure are.
Madam Chair, it's Eric. I'm sorry to interrupt. I joined the call just as the first vote, or the last vote was, the previous vote to this one was just concluding. So I was able to hear the discussion on this one, and I'm on, and I did vote in affirmative. Just want to make sure you're aware of that. Thank you.
Thank you, Eric. Great.
Sorry.
Excellent.
Sorry for being tardy.
This is Steve Meyer. Can I just ask a follow-up question? And do we think 6 months deferral is enough?
You mean for the property owners?
Yeah.
It's been our practice so far to do it. That a 6-month deferral is one payment deferral on CPACE generally, except for the transactions that pay quarterly, or those that pay annually, which is, I think we have just a very few of those. But most overwhelming majority are paid every 6 months. So we just figured we would just do it one at a time, and then keep in touch with the customers and see how their situation is, and just go step by step.
Gotcha. That makes sense. Thank you.
You bet.
Okay, so I think we can move on to item number 5. And this involves a specific project in Cheshire. And I think Mackie's going to talk to us a bit about again, some more proposed revisions, including the effective useful life component of the contracts. Mackie?
Yes, thank you, Chairwoman. This is Mackie Dykes, Vice President of Financing Programs. First item here that I'll go through is a CPACE project in Cheshire. First thing to note is the amount you're seeing here is slightly less than what the materials you got last week show. Before it was just over 2 million. We're down to 1.8 million now. This is there was a reduction in some of the O&M cost that was being financed. So the overall cost has come down, but the savings remain the same. So really only all positive impact on the metrics of the project. But what we're looking at here is a pretty large 666, somewhat ominous number there, but 666 kilowatt solar system at Lane Construction. They are, it's one of the largest provider of construction services in the country. You know, they're doing large civil projects, highways, mass transit, airport projects, things like that. Been around since 1902. Were recently acquired by a large Italian multinational firm operating in 50 countries. They've got an interest in sustainability, which has led them to explore this solar project. It's an interesting one. It's a roof mounted, a ground mounted, and a carport, all connecting into behind 1 meter. And there's also a piece or a component of roof financing for this. They're replacing a portion of the roof, so that's wrapped into the 1.8 million as well. Next slide. They're doing 25-year financing. So the interest rate is 6.5%. There is no mortgage on the property, so loan and lien to value are well within our established underwriting guidelines at 24%. The property is valued at 6.6, and then a very healthy DSCR here. Next slide, or one more. And the red line here reflects the changes. You know, I mentioned the cost came down. So you'll see the updated metrics with that reduced financing amount. The SIR was slightly improved. We're at 1.15 now, and the amount they're paying came down. But yeah, I think overall this is a project we're excited about, quite large. The borrower's a strong borrower, and the contractor, Virigi, is one that is becoming a growing important partner with us. We've done a few projects with them and have a strong pipeline building with them. So excited to do this one with them. One thing to note, thanks to, you can go on to the next slide while I talk. Thanks to there's been a significant delay in this year's ZREC auction. I won't bore everyone with the details, but there was a sort of a drawn out fight at Pura over some disqualifications that's resulted in the awards being about a month and a half late. We're expecting to get those in the next 2 weeks, but this project will need a large ZREC. So we would not, if you approve today, we would not close this until that project, or excuse me, until that ZREC is awarded. But I wanted to go ahead and get approval on the project contingent to that award. So I'll pause there for any questions.
Are there specific, I'm sorry, this is Steve Meyer, are there specific hurdle rates for the SIR?
I'm not exactly sure what you mean. Can you explain a little more?
Sure, but the savings to investment ratio is 1.15 here. Are there certain minimums you look for? Obviously, recover 100%, but what's your target in terms of these projects?
We don't have a target. The statute and the program require it to be 1 or greater.
Gotcha.
So yeah, that
makes sense. Okay.
Yeah.
All right. Thank you.
This is Lonnie. I think I read someplace in one of the memos that this company doesn't even have a mortgage.
That's correct.
They're totally healthy.
Mm-hmm. That's correct. No mortgage.
Any other questions?
Yeah, and Lonnie, I think a part of the reason they want to do this is that the company's parent, WeBuild, it's a global company. They're very big into sustainability. They're part of the Carbon Disclosure Project and are signatories to the UN Global Compact. And so this really is a move on their part to have their U.S. headquarters be a big example of what they're putting in all their materials in terms of sustainable goals.
Will they let us take people there to visit?
Good question. Well, we'll ask them.
I mean, it sounds like a jewel.
Yeah, we're planning a press release around it. Should everything, should the board approve? Should we get the ZREC award and we close? So it could be a good one especially once it's built, because this is you're going to have a big carport and a big ground mount. This could be a great on-site event.
Absolutely. So do I hear a motion to approve? Resolution
I have
2?
one question. This is Binu Chandy. The resolution includes some feasibility study loan. What exactly is that?
I believe that is really just template CPACE resolution language that's existed since the early days of the program. We technically have a feasibility study program that was set up years ago where we would give loans in advance of CPACE to as the name implies, study the feasibility of it. There's none envisioned here. So, I mean, we can strike that from the resolution if need be. Again, that's just template language.
Thank you.
Mackie, this is Matt. Do we need to add in the ZREC, subject to awarding of a ZREC language? I don't see that in the resolution either.
Yeah, we can add that in. I mean, as the administrator of the program, I have to approve all projects to make sure they meet the program guidelines. I would not be able to give that approval to allow the project to move to closing without that, because SIR is not met. So there is a governor in place, but yeah, we can. I think it makes sense from a financing perspective to add that in as well.
That's all right. I think you're right. It's in the resolve that you'll confirm it meets all the requirements. Okay.
Mackie?
Yes.
It's Bert here. I just wanted to make sure for clarification that the portion of the resolution that would be dropped would be the words, and if applicable, a feasibility study loan. Because we do have flexibility in all of our resolutions for up to 110% of the requested amount. Isn't that true?
That's correct, yeah. That was my understanding of the request just now. It was just to strike the feasibility study loan reference. Okay. So please let me know if that's not the case. And we'll change that going forward. I apologize for the confusion.
Sorry to talk twice on the same thing. One last question. Given their line of work, it looks like this building is their headquarters and they don't stage anything there or keep equipment there. Is that right? There's no brownfield issue?
We do an environmental screen on all our projects, and we didn't find any issues.
Any more questions or comments? Okay, do I hear a motion to approve Resolution 4?
Motion to approve. This is Brenda.
Thank you, Brenda. Second?
Second, this is Steve Meyer.
Thank you, Steve. All in favor, or discussion? Any more discussion? All in favor?
Aye.
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 Opposed? Abstentions? Good. Unanimous approval.
Right. Thank you, everyone. And now I want to go into a broader program issue. And for this one, you'll have to take your lending hats off and put on your CPACE administrator hats. So this is us as the, I guess the best way to think of it is the regulator of the CPACE program, by which both us and private lenders lend money through the CPACE platform. Our program guidelines are essentially our regulations for the program, and we're proposing really one change here, and the other one sort of falling behind that. But a change that's we're proposing to address all the or to allow something that's cropped up as we've been going through the COVID restructurings, which we talked about earlier with Clean Fund. The approach we're using with our borrowers is to extend, to defer at least, or defer a payment and then extend the term. Sometimes more than just one payment. We're offering them options, which different goals. Some to try to keep the payment the same as it is now. So in some cases, you're extending the term a year or a little longer. Currently, the program requires that financing term not exceed the estimated useful life of the equipment that's being financed. And a lot of the terms we have in place are the estimated useful life and the financing term are one and the same. And this is the case for some of the COVID restructurings we're looking at. So, we're hitting our limit of our ability to
Hello?
Did we lose Mackie?
Mackie?
I think so.
I think we
think,
lost him.
given the
Oh, there he is.
circumstances, not only of
Mackie,
COVID
Mackie,
restructuring, but really
Mackie,
any restructuring, that having that the
Mackie? We lost you.
Did you lose me for a second?
Yeah, for 30 seconds there. So just
Yes.
back.
Can you hear me?
Yeah, we can hear you now. Back up for 30 seconds and rehash that.
Okay,
Thank you.
I apologize.
No problem.
Okay, so the financing term cannot exceed the estimated useful life of the equipment. For many of our projects, including some of the projects that we're looking at now that need relief because of COVID, the financing term is, they did stretch it to the estimated useful life. So in order to provide the relief that the borrowers need, adding payments on towards the end, extending the term, doing so would violate the program guidelines. We believe in the case of both really COVID restructurings or any restructurings, it's not in the interest of the borrower or the lender to have this EUL restriction in place. A restructuring would only be envisioned in the case of borrower hardship. So it's in the borrower's interest to provide avenues for relief. They're going to want to have as much flexibility as possible to adjust terms. On the lender perspective, their options are either offer that relief or seek every avenue to recoup their investment, which most likely would be a foreclosure. So, we want to make sure that they have other options than foreclosure to address issues. So we're proposing to in the case of restructurings, to remove the requirement that the financing term cannot exceed the EUL. So this would be, I used the example of our projects and our COVID relief that we're offering, but this would be broadly for the program. Any lender would be able to offer this type of relief for a restructuring. And the second change, given that we're opening this up, proposing to open this up, we want to be crystal clear about what a restructuring is versus a refinancing. We do not want refinancings for the CPACE program. We don't want, a CPACE loan to be made by capital provider A, and then 5 years later, capital provider B come in and refinance that at a lower interest rate or a longer, if we remove the UL exception, a much longer term than the EUL. So we just want to be crystal clear about what a restructuring is versus a refinancing. And I mean, the primary difference is a restructuring is a change in terms of an existing assessment with the original capital provider. The original capital provider is not of their own accord going to come in and offer lower interest rates or a longer term. It's just not in their interest. The only time they're going to do that is when the borrower needs some relief in a restructuring. So by making it clear, refinancing would be a change in term with a different capital provider, whereas a restructuring is with the same. We're trying to avoid anyone taking advantage of an opportunity that this EUL exception would open up. So I'll pause there for any questions.
This is Matt. I have a few. One, if you want, Matt, I can put them all out there, or you can answer them one at a time. One is, in the definition of restructuring, it's a CPACE capital provider, but then it allows for or assigns. So is that a loophole to get around the restructuring versus refinancing? Bulkhead you're setting up. Then, two, I'm a little uncomfortable with the language to get beyond the useful life. It seems kind of open-ended. So I wonder if we wouldn't put, like a limit on how far beyond the useful life, maybe a year, if you thought about that. And also subjecting it to, otherwise subject to our write-off or write-down requirements for the bank. So you still have to meet with those parameters. And three, well, I think that's it. My useful life is that the further out we get, there may be payments that are upside down in the out years. So I was also wondering if you've thought about a way to protect against someone who's taken all the depreciation, taken all of the tax credits, and really in year 20, which is now extended, their SIR might be less than 1.
Okay. Mackie, could I step in here for a moment? Matt, going back to your first question, could you explain a little bit more about how assigns would be a loophole? I'm not sure I understand how that's what the concern is there. I just want to make sure I understand the concern.
The explanation was that we're trying to differentiate between refinancing, which we don't want, and restructuring, which we recognize may be a necessity. And the fundamental difference was that the restructuring occurs with the original capital provider, and what we wanted to avoid was other capital providers coming in and just refinancing under other terms. But if we allow the original capital providers assigns, to restructure, then essentially an assigned could be, in essence, a new capital provider, not the existing, it's just something with assigned.
Yeah, I think that the idea behind putting in the definition of refinancing is really to protect the existing capital providers so we can have an orderly program. Otherwise, we constantly have, people, trying to pick off each other's transactions after a lot of work has gone into building them. That was the idea there. So, so if a capital provider wants to relieve themselves of their position in a transaction by passing the benefit assessment lien to someone else, then they're kind of stepping into they're basically stepping into the shoes. And if they want to somehow provide relief, change the terms, lower the interest rate or whatever, I'm not sure I'm following how that's a bad thing.
Well, yeah, I'm not. Maybe it's not. I, from what you're saying, our goal there is to protect the original capital provider. That we, as the Green Bank, don't really have a stake as long as the original capital provider is happy. If that's the case, then right, the original capital provider could assign, and then they could, the new provider could refinance. Essentially, what would have been a refinance. So programmatically, do we care? If the answer is don't, then that's fine. But if the answer is we do, then and we want some say in that, then,
right.
Then
Well, Mackie, that's kind of where I think we were coming from. But if I missed a particular angle to the differentiation between refinancing and restructuring, maybe you want to add something to it. But I thought that's.
Yeah, Matt, the clean fund, what we just talked about, the clean fund falls into this, right? But it's not as, I think, blatant as what you're worried about. So, capital provider A does the original fee-based transaction, and then, like much of the market does, they sell that BAL to capital provider B and retain no interest in it. You could argue that capital provider, so they meet the definition. They are the original fee-based capital provider, but so they could potentially come in, and even though they have no. Well, actually, let me just go right to my restructuring definition says they have to be a party to the applicable existing financing agreement. So if I'm understanding your question correctly, you were worried about once capital provider A has completely gotten rid of the deal to capital provider B, them coming in 5 years later and taking them out, that the language would allow that. But they have to still be a party to the applicable existing financing agreement. And yeah, again, the thinking is there's no interest in them to do that unless there's a true need on the borrower side.
I think it would be if they were assigned, but maybe again, if you guys aren't worried about the program side, it's really about protecting the original provider from being poached. That's fine, but then I would still just go back to my first thought about putting some boundaries in the text about the extension of the useful life, because you could still have assigns coming in saying, oh, well, the program, applicable program requirements allow us to extend the useful life. We're going to extend it out to make it really attractive to this person who's the current owner, but it may not be as attractive to subsequent owners, depending on how far out they extend the useful life. I know that they don't have too, but it's a lien position, so it's a pretty good instrument for them.
Yep. So we have two restrictions on financing term. One of them is the EUL one, which we're talking about removing here in the case of restructuring. Separately, we have a 25-year limit. Just You could have a 30-year EUL, but you still can't go past 25 years without written permission from the Green Bank. So we still have that governor in place. And even in the case of restructurings, we're not looking to waive that. That would still be in place. So if they're looking to go beyond that, they'd have to come to us for permission. And, you know, we'd need a good reason to grant it.
Mackie, the way I read it in section 3, if someone, let's just say an assigned refinance in year 15, the new language in D would allow them to go beyond the useful life, and then the restriction you're talking about, 25 years, would be 25 years starting in year 15. I mean, I'm just making up, you know, a scenario, but that's one I think we'd like to avoid. Or am I wrong?
Let me think. So you're saying
in D, it just says, except in the context of restructuring, in which case benefit assessment may be extended beyond the weighted average useful life of the energy improvements, but it doesn't say how long beyond. So if someone came in year, let's say 15 of a assessment and said, let's restructure the deal for, well, we can't go more than 25 years, so let's add 25 years. At year 15, they'd be then at 35-year useful life. Would the rules prevent them from doing that?
I see.
I think that's a good point. That maybe we should say that in no case would a benefit assessment, restructured benefit assessment lien, be longer than 25 years from the original date of closing.
Yeah, I'd like to see that.
You know, or the original, you know, whatever is the appropriate date, Mackie. It's not the closing date, because the closing date includes like construction, and I know we start the clock on the 25 years at the completion of the project or whatever it is.
Right, the COD.
Do we want to say 25 years or the useful life of the equipment?
No, that's what we're dealing with here. Is that the useful life in cases of where we're restructuring and we're trying to avoid a situation where we're dealing with a problem of the customer being able to repay on the existing terms, then generally to make the payment easier for the customer to pay, you're going to have to lengthen out the term. And if you're already up against the expected useful life limitation, then the existing guidelines that staff has in place acts as an impediment to being more flexible with the customer, and you're facing a situation where you can't do anything for the customer, but take action to really foreclose. I mean, you're just kind of stuck.
I guess, Bert, I think that would be a good addition, but I mean, I'm just put out what I would like to see. I'd like to do that language you suggested, or it would be the lesser of that, or the EUL plus 1 year. And I just pulled 1 year out of a hat, but I mean, again, if we're talking about now, the middle of a pandemic, a year's a long time, and if the pandemic or whatever event happens in the next 20 years requires us to go beyond 20 years, we have a lot of runway for you guys to come in and tell us. But just adding what could be up to 5 years, may tempt people to refinance for other reasons. And I just worry that toward the end of the life of these projects, they're not going to be as cost efficient as they are in the beginning. And, we don't want, as much as our money will be returned to us from our other mission of supporting and growing clean energy, we don't want to have a lot of what would be considered failures by future owners. We always want this to be a good deal.
Yeah, well, in that particular case, though, Matt, I mean, once a property changes hands, the next property owner is always going to make a judgment as to whether the property, with all of its benefits and burdens being regular property taxes, C-PACE liens, etc., that's all going to be factored into the purchase price, don't you think? I mean, so it seems to us that the adjustment will be made by that next owner. So if it were to be upside down for the present owner, the next owner is not going to step into a situation where they're looking at the building saying, "Oh yeah, I'll step in exactly the same position as the existing owner and be upside down." No, what would happen is they would pay a lower price in order to, at the very least, get to a situation where they weren't upside down anymore.
But that's exactly
all things being equal.
This is Lonnie. I'm just wondering if we should build in some sort of trigger that, if we get into a complicated, revisiting one of these contracts, that they would come back to the board or to a subcommittee, a relevant subcommittee of the board, just to kind of re-examine it and put eyes on it again.
The issue is these aren't potentially all our contracts. We'll have private lenders that will be subject to these rules as well. So I think we'd have to think about our ability to peer, and I think we need to set the rules and the guidelines.
We can always loosen them if we set it at a year. I mean, the situation you described is exactly what I'm worried about. If having solar becomes the point of contention that requires sellers to negotiate down their selling price, that's a big black eye for us, and would be a really label solar liability. So I would say start with a year, and if you find that's not enough flexibility, work your way up.
Well, I don't know, Matt, I find it hard to be able to know in advance if that's a black eye for us, if the reason why the customer can't pay perhaps just has to do with their own circumstances with the business that they're operating. So, I mean, it could very well have nothing to do with our program. And all we're doing is we're trying to, help the customer, right size their obligations, as may be the case with their mortgage holder as well. So, I mean, I'm struggling with your point, is all I'm saying.
I'll leave it. I don't want to bore everyone. I guess all I'm saying is we're always going to be measured against our SIR, our savings, as opposed to other parts of their business, which, yes, they could fail at. So if in the out years our SIR is bad, then the implication to new buyers is, I don't want to buy into your bad project.
Right. Well, I will say that with the exception of the situation that we currently are experiencing with COVID, this program has gone since 2013 with Mackie. I think we have had no issues at all in our portfolio.
Not to the point of foreclosure. Yeah, I mean, you've had some late payments, but.
Yeah, late payments, but nothing where we've had to actually restructure anything. So this is really, I mean, absent that one transaction with the Y.
The Y, I think there was one other.
Okay, well, we've done over $300 million of transactions. So I mean,
and it's I think my point.
My point is it's rare. So I don't think we're really, But when it happens, Matt, it's a constraint. I mean, I think one is too tight. Would you be okay with 3?
Yeah, well, as I said, I really picked one out of thin air. I guess I'd be, if 3 is better than open-ended to me, but I guess I'm just thinking 3 is 6 payment cycles. If you guys could give us some sense of why we would need to restructure for 6 payment cycles, that would be helpful. But I wouldn't be opposed to 3. I just don't have any basis to evaluate it on, because we're in a pandemic and we're talking about extending for 1 cycle or 2. So.
Well, I think that what we have is we have one payment that when we accrue interest on it, that actually ends up adding 2 to 3 payment cycles, is what we've discovered. So I guess what we could do is we could say 3 payment cycles. Mackie, do you know if anything in what we've been looking at so far breaches that?
Bert, how about 2 years then? That's longer, and it's still shorter than open-ended. That should give you.
We'll take it. We'll take it. Sold. Anybody got a gavel?
I missed that. What was 2 years? I couldn't hear.
2 years.
Oh, did we say, okay, that's what I was going to chime in with. I figured let's split the difference.
All right, we got 2. We'll take the 2.
Okay.
EUL for 2, and if it's anything other than that, we've got to trot back to the board for extenuating circumstances, no matter who it is, whether it's us or another capital provider.
Good. So do I hear a motion to approve? This is 5B, right?
So moved.
With that limitation.
With the limitation of 2 years for the EUL.
Yeah.
This is Steve Meyer. Can I just ask a question? I mean, the 2 years, candidly, 1 year was pulled out of the air. 3 years was pulled out of the air. Have we been thoughtful enough around, the likelihood of a restructuring, the circumstances around such a restructuring, and I'd like to see more of a quantitative assessment of what really makes sense or not.
Well, Steve, the point I was making was that with the transactions that we've been restructuring to date with a one payment deferral with interest, that ends up being between 2 and 3 payment cycles extension. So a 3 payment cycle extension would be 18 months. But that would mean if an existing customer needed a further extension, then we'd have to come back to the board. But I mean, personally, we'd have to come back to the board anyway, because it's beyond a 1 period deferral, and that's all that was approved in the COVID restructuring process. It could have been the first meeting you joined, or it might have been the meeting just before you joined. I don't recall.
So,
but new ground for me. So sorry, I'm catching up with the rest of the board.
No, that's okay.
I just wouldn't want to tie your hands in terms of negotiating a restructuring that isn't a refinancing and a restructuring based on hardship. I'd like you to have that flexibility to be able to cut whatever deal you think is best and necessary.
So
go ahead.
I'm sorry to interrupt, but so the best data we have is exactly what Bert's referencing. Is what we've seen with our COVID restructurings. Nick Zuba and I have been messaging each other, and he was looking at those projects. So Nick, correct me if I'm wrong, but it looks like one of those, what the borrower wants is an extension of 2.5 years beyond the current EUL, and that's the longest one we have. Is that correct?
Yeah, that's correct. That appears to be one of the longest ones right now.
So that, and is that choice, we're going out that long in order for them to maintain their existing payment amount? Is that right?
Yes, that's correct.
Okay.
Thanks, Nick.
Gotcha. Okay.
So it looks like we really do need 3, or else, we can't help that customer.
So where are we now? So Matt, how are you feeling about 3?
I like 2. Customers always ask for what they want, but I just think if we start to get more of them, we can change this in a heartbeat. But I prefer 2, but I'm only one member. We're talking 2 years, not 2 payment cycles. 2 years. It'll be 4 cycles, right?
Right.
Correct.
And Steve, this is Lonnie again. Steve?
Yep.
What are you feeling? what are your feelings about
I
3
liked
years?
it initially. Well, I defer to others that are actually doing the restructuring. I'm just asking the question whether that's enough flexibility in order to restructure these things in a satisfactory way. And again, I don't remember the gentleman speaking up front, but it was very clear that these are restructurings based on financial hardship. And just obviously want to make good, prudent loans, and restructuring being part of that. I just was wondering, why would we tie the restructurer's hand at 1 year or 2 years if perhaps they need 2.5 or 3 or 3.5?
So you prefer the original proposal?
I do.
Yeah.
Only because it's less defined and more flexible, I think.
And what about you, Banu?
Can we carve out some language just for this COVID situation? And, just restrict this language only for this a couple of years or 3 years and then go back to the original language.
Mackie?
We can't, yeah, we originally talked about that, but we thought I thought it was muted. Okay. Yes, we originally talked about that, but we thought that the issue at heart still remained, no matter what was causing the financial hardship.
Yeah, exactly. I mean, if a customer can't pay, and what in a typical lender borrower situation, you're coming back to the table to try to see how you can work it out. And if you've got this limitation that says, well, we can't go beyond this, then it just forces the issue.
Well, it just requires you to come to the board, right? It doesn't prevent that being worked out. The idea being that if it's more than a certain amount, the board probably wants to know about it anyway.
But so for us, as a lender, we have authority for COVID-related restructurings to offer one additional term. We don't, if that, excuse me, we can defer one payment. We can't even do that though if it breaks this EUL restriction. But let's say that restriction goes away. We decide to move that restriction. As a lender, for non-COVID projects or for COVID that want to go beyond a term, we still have to come back to you for any of those restructurings, regardless of what's decided here. This is the program guidelines. It doesn't change our governance structure for green bank lending.
Right, but for private lenders, if they're doing the restructuring, they would be prevented from going out 5, 10, whatever years. And if they wanted to, they would have to come to you basically and say, program rules don't allow this, but we have this project that really is in need of a bigger fix than typical. I mean, we've already established typical is less than 3 cycles. So we're really talking about things that are outliers in our current experience.
Yeah, and I agree with you, but I think we should have some sort of, I think our original open-ended proposal did expose that loophole. I didn't think about, that they could be starting from year 0 with the new one. So I do agree there should be some limit on what's allowable even from an EUL perspective, what they're adding. Personally, I think COVID, God willing, this is the absolute worst factor in enforcing restructurings we're going to see. So this one we're looking at that's 2.5 years is hopefully going to be the worst. So I think the 3 that was tossed around, I think that's good. We have good data to show that that's an appropriate one. So that's sort of where I would land in terms of modifying our original proposal. But understand, I think a case certainly know if there's a case to be made for a lower number.
So in the interest of moving it, should we just pick 30 months and move it?
Matt, was that you speaking? I couldn't hear you.
Oh, Bert, I missed that.
I said I couldn't hear you.
Oh, I said, can we just arrive at 30 months? That's 2.5 years.
I think, Nick, does that,
If it's greater than 30 months, let's bring it back to the board, gang. We got to move like the
Yeah, no, I think definitely bring it back to the board. There's some language issues and conceptual issues here, I think, that we really need to feel comfortable with. And we're losing people. They're dropping like flies.
Right.
so
We have our quorum.
yeah, the lesser of 30 months or the lesser of 25 years or EUL plus 30 months.
Yep.
So do we want to move this with that language change, or do we want to revisit this later?
Well, I already moved it. If you want to, I'll have to amend by motion, or if you want to revisit it later, I don't know if you saw the thing.
Well, in order for us to move with tranche one, we have one transaction in the tranche one in the clean fund transaction that actually requires an EUL adjustment or EUL waiver.
Okay, so that's happening now. That's
Yeah, so we'd request the amendment to the existing motion.
I'll amend my motion to include the 30 months instead of 2 years and language that we just discussed, the lesser of. All you need is a second.
does anybody want to second the motion?
Second.
I'll second it, John Harity.
Okay. Any more discussion?
Nope.
All in favor?
Aye.
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 Anybody else? Opposed? Any abstentions? So I'm not sure where we are numbers wise on this one.
Do you want us to vote by name?
Yes.
Is that easier? I was a yay. Steve Meyer?
Steve, okay, great. Binu?
A. Binu Chandy?
Yes. You said?
Yes.
Yes, great, okay. John, you said yes.
Yep.
Matt, you're yes now.
Yes.
And I'm a yes. Who else is still with us?
John Harity and Eric Brown.
Okay, and Eric? I have John Harity as yes, and Eric? Not hearing Eric.
Quorum may have been killed.
Yeah.
Let's see. Eric, are you there? Eric Brown? Sometimes he's on mute.
I can text him.
So I'm a yes. So there's 1, 2, 3, 4, 5 yeses.
We need 6 for a quorum.
That's what I thought. Eric?
We could hold here till we get a quorum, see if Eric can come back, but my suggestion would be we should move along and have the board hear the next presentation, and if we have to come back for a quick call on both resolutions, we should do that, because we need this resolution is probably the most important of the day.
Okay. And this is exceedingly time sensitive. Item number 6, incentive programs and RSIP, and I guess we're also trying to deal with it legislatively, but it's clear that we really need to interact with PURA and have a plan B. Who's going to explain this to us?
I'll run this one. So thank you all for your patience hanging in here. Let me see if I can get through this in 5 minutes. So we are nearing our statutory target of 350 megawatts. We have about 340 megawatts of approved projects. Just really quickly, in terms of the public policy goals that we are supposed to achieve as administrator of this program, one is to administer a declining incentive block structure. We've managed to reduce incentives by nearly 90% since the program started in March of 2012. The second is a clear 350 megawatt capacity target, deploy no less than 350. I underline deploy because we have 340 megawatts of approved project. We need to deploy them. So we have some cancellations, which I'll talk about. And then the third is the one that we've been hanging out in the last year to 2 years, really focusing on this, which is the economic development goal of the statute, which is to foster the sustained orderly development of the industry to ensure that we have a long-term marketplace for local contractors to support residential end-use customers. As you all know, we are in a transition period as Connecticut looks to transition from net metering to a tariff-based form of compensation. We're also heading into a climate where the federal ITC is going to be reduced from 26% to 22% and then down to 0% in 2022. And then lastly, we've got other policies that are being administered out there that are being able to help their industries through COVID-19 by either having another year of incentives or increasing incentive levels. So we don't have that given the structure currently of the RSIP policy. We left in the MOU a number of pieces of information. We've been tracking this. You all know we've been on this since April, since COVID hit, the destabilization of the industry from unemployment claims. We left the memo in there on the solar PV market specifically, industry surveys that we've been working with the governor's office, DECD and others on, the utilities. Program data, we actually can track this in terms of customer acquisitions and project completions. And then recent polling data, which is this question, and they all indicate that the industry is completely unstable. So as we're heading into an environment where the federal ITC is going to come down again, and we've got the economic uncertainty of COVID, right in the middle, sandwiched in the middle of that is the uncertainty with regards to the RSIP incentive. So this is a key stabilizing factor for the industry. So what we're proposing are two things. One is so that we can hit the 350 megawatt target is allowing us to approve 10 megawatts more. So we'd be approving 360 megawatts. There is a cancellation rate that we've been tracking that's roughly 15 to 20%. So by us approving 360, we will indeed achieve the legislative target of 350 megawatts. But should there be less cancellations than we anticipate, then we are exposed in terms of providing more incentives that won't be cost recoverable, at least now through the master purchase agreements with the utilities. So the first thing here is to achieve the target. The second thing here is to stabilize the solar industry by increasing our ability to approve 32 megawatts of additional approvals beyond 350 so that we can help stabilize this industry. The Energy and Technology Committee, as you all may be aware, has some much more important priorities on their agenda currently, dealing with utility rate increases and storm response. So that has become the focus of the legislature, not the economic development of the solar industry. So it's on us to figure out the solution for the industry. Our strategy on that exposure is identifying ways to cost recover without having the long-term master purchase agreement with utilities at a price we set. The first is that we would continue to aggregate these residential systems. We provided our comments into PURA through docket number 171203 RE9. suggesting that they continue to allow the Green Bank to aggregate like we're doing under the RCIP and the SHREC. We got really positive support from Solar Connecticut in a hearing earlier this week expressing their support to allow the Green Bank to do this. We anticipate PURA taking a look at this and ruling on this in the next couple of weeks. So that would be important for us. The second is we would decline the incentives and another step beyond current step 15, essentially reducing our exposure. You can see here the REC price equivalent of our different incentive types. Overall, we're at about an $18 per ZREC equivalent, which essentially means that if we received $18 per REC for the next 15 years, we would cost recover our incentive on a nominal basis. So we've established, number 3, a target of $20 on average to execute this strategy. I can tell you that the last 5 years we've been selling RECs in the market, the spot market, and we've had an average over $20, although year 1 of that we were near the alternative compliance payment at $49. We are looking ahead. The markets, if we went into the market today, we think we can get a $36 REC in Connecticut and a $41 REC in Massachusetts. So we think we'd start off ahead of the game if we pursued this strategy. This is just a picture of where REC prices have been. I think the interesting thing here is that in Connecticut, the alternative compliance payment for the RPS drops from $55 to $40 starting in 2021. So the price that I just showed you, $36 of 40, means that Connecticut is under supply in its class 1 RPS looking ahead, which is good for us in terms of cost recovery, not so good from the state in terms of having to pay more RPS compliance costs. We've taken a look at all the different scenarios, the worst case scenarios from a discounted cash flow basis, and we've identified ways of mitigating risk on the REC price. We're going to continue to push the extension of the RCIP. If there's a special session or a 2021 session, we're going to keep pushing it. In the meantime, we're going to see if the utilities want to do long-term procurements. There are some policies that would allow them to do that. We put forward a REC-only interim tariff to PURA in our filings. And if none of those go through, then we're looking at the markets and we can sell them in Connecticut and Massachusetts. And our goal is to beat that $20. And looking at the years ahead, we're looking at $36 to $41. So a good market ahead. And that is the resolution. So this is an economic development resolution to continue our support of the market. This market is completely unstable. It's not the time for us to claim victory on the RCIP, because if we walked away, we're likely walking away from an industry that's going to collapse underneath us. So this is a proposal for the Green Bank to stay in and support the economic development of the industry. And that's the resolution.
Okay, any questions?
It looks like somebody else came in. I don't know if Eric came back.
So Eric is telling me he's on now.
Okay, great. So now we have.
Oh,
Perfect.
good. There you are. Here you are.
Thanks, Eric.
So do we want to move to approve this resolution 6?
I'd make a motion to approve John Harity.
Any seconds?
Second.
Who was that, Matt?
Yeah.
Okay, all in favor?
Aye.
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 Opposed?
Aye.
Opposed? Abstentions? Okay, and I think we want to return to 5B. And I have, the only person we didn't hear from was Eric.
Do we want to just give him a quick summary and then move the item?
Yeah, my apologies. I had to drop off. So sorry about that.
Okay, well, we had a long discussion, and you may have been there for part of it, about the effective useful life, whether that could be massaged, shall we say, when these contracts are being restructured, you know, given the COVID impacts. And there was some concern that that they didn't want to make it in perpetuity. And so I think we finally decided on, what was it, 30 months?
The lesser of 25 years from the commercial operation date, or 30 months.
30
EUL
months.
plus 30 months.
EUL
plus 30
plus
months.
30 months. Yeah.
And also that, you know, they'll be returning to the board when these contracts are being restructured, you know, when they hit a certain dollar figure and certain, you know, key measures. Do you have any questions, Eric?
I don't think so. I don't want to delay the proceedings. So, did you take a vote on it already or no?
We took a vote and we had everybody yes, and we would love to have you.
Yeah, no, I'll vote affirmative. I mean, you know, sounds like there's a lot struggling here between COVID and other things, and I'm not sure how much to attribute it to COVID. But I think it's good that you put a time limit on it. So I'll just leave it at that. You can mark me down as a yes.
Okay. So we've got, let's see, Lonnie, Steve, Benu, John Harity, Matt, Eric. Yes. So that looks like we've concluded our business. And do I hear a motion to adjourn?
So moved, John Harity.
A second?
Second, Binu Chandy.
All in favor?
Aye.
Aye.
Aye. Yep.
Okay, thanks everybody. And that, you know, this was very complicated stuff, and I think the discussion was really, really beneficial. So thank you to everyone.
Eric,
Thank
thank you for coming back on.
Yeah,
Yes,
thank
Eric.
you, Eric.
That was great.
I'm having all
excellent.
kinds of fun with special session proposals, so my apologies.
Oh, goody.
Better you than me.
You rode into the rescue, Eric, so we appreciate that.
All right, take
This
care.
time, thank
Bye-bye.
Stay well,
everybody.
everyone. Yep.
Bye-bye.
Bye-bye.
Thank you guys. Bye.
Bye-bye.